Simon, are we going to get a real volatility index or a real gauge of sentiment, of fear with this new VIX 1D index?
Well, I think it's certainly going to make things a lot more transparent. Amidst all the kind of excitement of the banking crisis, I think zero-day, trading kind of got a little bit forgotten about, but it's still there. I mean, you go and look at the most active traded options, almost all of them are, either 1 or 0 days to expiry. So it's a huge part of the market. And to say two things I think you've got to bear in mind. One, it increases leverage because to trade zero-day options, you don't need to post margin. And second of all, as you alluded to, the VIX basically becomes, or has become, a lot less representative of what's actually going on. A good analogy is, if you imagine like a pot of almost boiling water, the surface is very calm, but underneath it's very turbulent. And the turbulent part is kind of like the zero-day trading, and the surface is the VIX.
And another metaphor I know you've used, Simon, is ducks.
Yeah.
Very ferociously underneath the surface.
Always water-related.
They're always water-related.
Yeah.
I mean, how do we need to be worried about those ducks' feet and that volatility or perhaps instability that could be caused?
Well, I think when you take two things together, when you have a lot of, as I say, extra leverage being taken, and you have a lot of people pursuing the same sort of trading strategies, they tend to chase volatility lower. We saw that in 2018, which means that people have to take on more risk. And if you combine more leverage with more risk, it tends not to end well. Now, I'm not saying it's an immediate risk, but 100% you want to add your one-day VIX to your kind of screen of things to watch, because it's very much a part of the risk pattern out there.